A lot of business owners don't realize this yet, but the way that banks evaluate your company for funding has already changed. They're using a new digital scorecard behind the scenes, and most people don't even know it exists. And here's the surprising part. The thing that used to help you, showing strong revenue, might actually work against you in 2026. The rules have shifted quietly, and it's creating confusion for a lot of good businesses that should be getting approved, but they aren't. So what I want to do in this video is walk you through what's really happening in plain, simple language. No hype, no pressure, just clarity on what's going on. My goal is to help you understand the financial landscape of 2026 and give you the tools to position your business the right way so you can access capital confidently, not out of desperation, but out of strategy. Let's start with the big picture. There are two major forces in the economy right now, and they're moving toward each other in a way we haven't seen in years. If you understand these forces, you'll understand why some business owners will have access to the best funding of their lives over the next 12 to 18 months, while others get stuck dealing with rejections that don't make sense. The first force is interest rate relief. For the first time in a long time, we're heading into a cycle where money is getting way cheaper. The Federal Reserve is expected to lower short-term interest rates through 2026, possibly by as much as 2 percentage points. For business owners, this matters way more than most people even realize. A 2-point drop has a huge effect on your monthly payment, your cash flow, and your ability to borrow confidently. If you've been holding off on expanding, buying equipment, hiring staff, adding locations, this is the first sign that the environment is starting to shift in your favor. And what makes this even more significant is that economists expect demand to rebound in early 2026. So we're entering a rare window where capital is getting cheaper at the same time the market is heating back up. That combination doesn't happen often. When it does, the business owners who prepare early end up in the strongest positions. They get approvals, they get better rates, they get bigger checks, and they get them without jumping through endless hoops. But, and this is where the second force comes in, it doesn't automatically mean funding is going to be easy, because at the same time money is getting cheaper, banks are tightening their lending standards, and they're not shy about it. They're asking for more documentation, they're requiring stronger financials, they're pulling back from perceived risk, and they're approving fewer files than normal. I've talked with a lot of business owners over the past few months who said the same thing. My business is doing great, we're making a ton of revenue. So why did the bank still say no? The answer is because the bank isn't looking at the revenue that you're making. They don't care about the top line. It's not enough to show high gross income anymore. The new scorecard focuses heavily on one thing, your profitability. And that's what you as an operator should be focused on as well. Because it doesn't matter how much money you make, it matters how much money you take home. Let me give you an example. I worked with an owner who runs a successful contracting company. Contractors are our number one clients because they always have to bridge receivables. His revenue looked fantastic on paper, strong year after strong year. But when the bank looked deeper, his profit margins were extremely thin. Not because he was mismanaging anything, just because his industry has tight margins. They gotta spend money on materials, payroll, subcontractors, and all the lot. The bank denied him not because he wasn't doing well, but because their new standards put more weight on margin than volume. Once we adjusted how his expenses were categorized and cleaned up his statements and P&L, he got approved. And this is what's happening across the board. Profit is the new king. And if your profit isn't clearly demonstrated, your funding options shrink considerably. This brings us to the most important metric you need to know for 2026, your DSCR, your debt service coverage ratio, how much you can afford with your profit. If you take nothing else from this video, take this. DSCR is the number banks and conventional lenders care about most. DSCR answers one simple question. After your expenses, do you have enough cushion to comfortably make your debt payments? A DSCR of 1.25 means you're generating $1.25 difference in income for every dollar in payments you owe on a loan. But the sweet spot, the one that gets you the best rates and the biggest approvals, is higher than a 1.25. It's a 1.5 DSCR. That tells lenders you're the one in control. You're not stretched thin at all. You've got great margins. And it's tough with some industries, but you can do a lot of things to get there. And here's the honest truth. Most business owners don't know their DSCR, and it does depend on the kind of loan that you're getting. It's not something you see on your tax returns or your profit and loss statement unless you calculate it manually. And because business owners don't know it, they walk into the lending world blind. They're hoping for approval instead of understanding what lenders see. Now, let's talk about the other major shift happening. And this one affects how fast you get funded. AI underwriting. Traditional banks are still moving slow. They use committees, lawyers of review, and outdated systems. But pretty much every fintech lender right now is using artificial intelligence to underwrite files in minutes, not days. And the speed is real. Some business owners get funded in the same day. But here's the catch. AI underwriting is based entirely on real-time data pulled directly from your business checking account. Not what your tax return said last year, not what your accountant cleaned up, not what you tell the lender when you apply. The AI sees your true financial habit, your cash flow patterns, your average balances, your deposit consistency, your spending rhythm, your customer payment behavior, and the credibility of your customers as well. Even your reputation scores. You can't hide anything from AI, and that's a good thing if your business is prepared and you're proactive. It means no explaining, no defending, no hoping, just clean, fast, easy approvals. But it also means you can't fix your file last minute. The habits you have now become the story that AI reads later. This is why I tell business owners that we work with, don't wait until you need the money to get ready. It's better to be proactive than reactive. Prepare long before you need the money. You want your bank statements to reflect a business that operates with discipline and stability. When your DSCR is strong and you've got all the boxes checked and your cash flow is healthy, lenders are going to compete for you, not the other way around. Once the foundation is in place, the next step is knowing which funding tool to use. This is where a lot of business owners make mistakes, not because they're careless, but because they just don't teach this stuff in school. Nobody ever taught them how to match the right tool to the right job. If you're buying equipment, especially long life assets like machinery, vehicles, or yellow iron, you should use equipment financing as your tool. The terms are long, the payments are stable, and the loan is tied to the asset itself, which usually makes it more cost-effective and economical. This keeps your business clean. It keeps your other funding options open, and it prevents lenders from putting a blanket lien on your company, which can choke off future growth. They only put a lien on the equipment. Let's talk about your next tool. If you need a safety net for everyday operations, a buffer between expenses and receivables, then you're going to want a line of credit. A line of credit is one of the most powerful tools a growing business can have. It lets you smooth out cash flow, handle payroll during slow months, and take on bigger jobs without stressing over timing. And the best part is, you only pay interest on what you use. And the earlier you pay it back, the more money you save. Revenue-based financing is another option. Fast, flexible, and easier to qualify for, but it's typically way more expensive. If you do go this route, make sure that you do two things. Work with an experienced broker like myself and negotiate early payoff discounts. If you get prepayment incentives on these sort of credit facilities, these things can save you a ton of money and turn a more expensive product into a strategic one. Now let's talk about acquisitions, because this is where 2026 presents one of the biggest opportunities in my opinion. Buying an existing profitable business is often the fastest way to scale, whether you're buying a competitor or getting into a new industry. SBA 7A loans are perfect for this because they offer long terms and manageable payments. But the SBA is tightening its rules starting January 17, 2026. You'll need stronger credit, more equity, and a cleaner financial file to qualify. That means if you're considering buying a business, the next year is a crucial planning period. And one more thing worth mentioning. If you're in manufacturing, the SBA is waiving key fees on 7A loans up to $950,000 for all of the fiscal year of 2026. This isn't a small discount, it's real money. And it's temporary, so manufacturers should absolutely take advantage of it while it's available. Here's the bottom line. The funding world is changing quickly. Not in a way that should scare you, but in a way that rewards preparation, proactiveness, and punishes guesswork and reactiveness. Business owners who understand their DSCR, who manage their cash flow intentionally, keeping high daily balances and good profitability, and those who choose the right funding tools will thrive. Those who wait until the last minute or rely on outdated assumptions will struggle to understand why lenders keep saying no. So if you want clarity, if you want someone to walk you through your DSCR, aka what it is that you can afford, your funding options, and what lenders actually see when they look at your file, there's a link below this video. Schedule a call with me and my team. It's not a sales pitch, it's a conversation. Whether we work together long-term or not, you'll walk away knowing exactly where you stand, what you can qualify for, and what steps will put your business in the strongest possible position for 2026. You've worked hard to build your business. You deserve real clarity, real options, and real strategy with real professionals. Let's get you there.